Good afternoon and welcome to Stonehearth Capital Management's quarterly update webinar series, CIO's Corner, with our Chief Investment Officer, Chris Gauthier. I'm Amanda Sylvia, and I'm the Senior Client Service Associate at SCM. Before we dive in, just a few quick housekeeping notes. Please use the Q&A button at the bottom of your Zoom window to submit any questions that you may have throughout the webinar, and we'll aim to address as many as we can at the end of the webinar. If we do happen to run short on time, either Chris or myself we'll follow up with you directly just to ensure that your questions get answered. I'm thrilled to introduce our speaker today. Chris Gauthier is Stonehearth's Chief Investment Officer. He brings over 25 years of experience in investment management. He oversees our firm's investment policy and strategy, including asset allocation, risk management, research, and portfolio management. Chris, thank you so much for chatting with us today.
Thank you, Amanda. Thank you for that warm introduction. Good afternoon, everyone who's on the East Coast. Those of you joining us from the West Coast, good morning. Thank you for joining me today on this seemingly warm fall day in New England. Don't see these too often, but we'll definitely take it. So today, I've titled the presentation, Separating the Signal from the Noise. And it's kind of, to me, it's just really trying to find out what really matters to markets, trying to find the data points, the weight of the evidence that will be able to successfully have your portfolios invested by separating the noise from the signal. So we're going to go through a lot of some data points today, looking at the economics, valuation, technicals, what it's telling us, and really trying to attempt to find out what this data is actually telling us, what that signal is. I do have to apologize in advance. I do have battling the end of a cold here, so you may hear me coughing a little bit. So I apologize in advance for that. So it definitely was an interesting night last night. I did have a few slides on the election, mostly about the uncertainty that we were going to experience today. We had to put those out, obviously, since we did get some certainty last night, but we are still waiting on the House. So there's not really a lot to speak about on the long-term investment implications till we know the total makeup of the government. But you're seeing the market reactions, at least in the short term today. So with that, let's look into what happened in the third quarter 2024. And what we're looking at here is asset classes that we always look at. Anytime you see blue, you want to think U.S. equities, NASDAQ, S&P 500. When you look at those green bars, that's everything overseas, international assets. Think Europe, Japan, China. Anything in purple is going to be fixed income land, right? Think bonds, U.S. treasuries, corporate bonds. Anything else that doesn't fit into one of those three categories is going to be in yellow, and that is gold, commodities, oil. You look at the performance, despite some bumps along the way, it was a really good quarter for financial assets. We had REITs up almost a little over 17%, U.S. small cap stocks up over 10%, double digits. Even long-term treasury bonds managed high single-digit returns in 8%. This really was driven by the continued economic growth we're seeing in the data and a very dovish Fed who delivered on the 50 basis point rate cut in the quarter. So really the only laggard here was oil and the dollar, who's really trading on some different issues kind of unique to their own. But again, a lot to like in the Q3 2024 performance if you're an investor. And I want to talk about the breadth a little bit because we showed this chart last time we met, looking at Q2 performance, and we've seen a 180-degree change from the last time we spoke. We look at these charts. The orange line is the equal weighted S&P 500. So that's all the stocks in the S&P 500 just weighted equally compared to the SPY in blue, which we all know is the headline index and market cap weighted. Last time we spoke, this was +6 to the good for the S&P 500 market cap weighted index, which means that large cap stocks pretty much outperformed and very concentrated by 6%. And if you look at the chart here, you can see the total reversal, right? Equal weighted outperformed. Those are small cap stocks outperforming those larger cap stocks, even though the larger cap stocks still did well, up 5.5%. So this is a healthy sign to us for the markets. Think signal. Bull markets are strongest when broad, weakest when narrow. So we actually see this breadth, and we'll take a closer look at this breadth that we're seeing really across the global equity complex in a few more charts. This is a very healthy sign for the performance in Q3 2024. Turning to a longer time period, we're looking at the same asset classes that we looked at in Q3. The colors all match the same, just a little bit longer time period, looking over the trailing 12 months. The magnitude is larger in terms of performance, which is good. More time passed, you should get some bigger returns, but the story remains the same, right? It was a good time to be invested in the market over the past 12 months. Still oil lagging behind, 13%, but really other than that, you could throw a dart at the board and get some pretty decent performance. Long-term treasuries right in the middle of the chart there, up 15%. We were seeing negative returns in fixed income just 2 or 3 years ago, so it's nice to see those bouncing back. Definitely led by the U.S. Those are those blue lines, NASDAQ, S&P 500, and REITs, which is just real estate trust. Definitely leading the way. But again, I'd take an even odd bet that if you ask someone what was the best asset class performing over the past year, you wouldn't get a lot of people saying gold. Yet it was up 41% in the best performing asset class that we look at over the past year. So good time to be an investor again over the past 12 months. So now I want to take an even further step back, and you can see just how far we've come. So what we're looking at here is the S&P 500 long-term returns going back to 1996. You can see that really had this bull market start October 2022. See right here was the time of recent low, and it's just been a straight moonshot, a few dips here and there, straight up to the top. What one could do this is compare this to history. We're like, what are we looking at compared to other moves that we've seen in history? And you can see that this move right now has been about 61%. We look at this move over here from the 2020 lows, that was 114%. This big one from the financial crisis, that rose almost 400%. '02, recovering from the dot-com bubble, up 100%, even going back to the 90s, up 100%. So again, what this tells us, it implies we may have more runway ahead of us. As quick and as fast as this market rise seems, it's only up 61% compared to 100% for other bull markets we've seen. And again, it is expensive, no doubt about that, but it may have a little bit more room to run here. A lot really will depend on how the macro environment plays out in the near future. So in the next few slides, we're going to attempt to give us a clearer picture of the economic environment by finding the signal through the noise. So as we always do, we're starting with U.S. monetary expectations and the Fed. I am very happy to report, I am glad I can finally say this, the impact to markets is fading from the Fed as we return to a more normal Fed funds rate. So it'd be nice to talk about true economic data and earnings rather than what the Fed's going to do. And really because investors and the Fed have really agreed on what's going to happen. So what we're looking at here is the U.S. monetary expectations, like the Fed funds rate going back to 93. Anything in these dark lines is history of what has happened. So right now we're at 4.88, and that's because the Fed uses a range on exact numbers. That's why you get that average at 4.88. And then green right here is what the market expects. This is what the market expects the Fed to do. And the blue is what the Fed's telling you it's going to do. So you can see, directionally, they're in the same direction, right? It's the same direction. Magnitude's off a little bit, not too bad, but again, going in the same direction. So again, given that we're getting to a more normalized Fed funds rate, the market and the Fed are really in agreement. In fact, the Fed is supposed to decide tomorrow, and it's about 98% chance they're going to cut by 25 basis points, and we agree with that assessment. The big takeaway and the signal is that at least in the short term, the Fed will continue to be accommodating, right? And when the Fed's accommodating, that's good for financial markets. And in addition to the Fed, the overall monetary environment is supportive of risk assets, as you can see in the next chart from NDR. So this is looking at monetary conditions from a different viewpoint than just the Fed. You can see down here in this call-out box, 1, 2, 3, 4, 5, like 10 different indicators, all trying to attempt how easy is it to borrow money? Is money available to move around the system, or is it stuck anywhere? There's a plumbing work. How much M2 is out there, which is just the total stock of money? How much is government spending? Can corporations borrow? And you put that all together, and it tries to give you a picture of, is the monetary conditions easy? And why do you really want to attempt to find that out? Because when monetary conditions are easy throughout history, you can see the market does well, right? And it makes common sense. If there's more money out there to invest and it's easier to get, then companies tend to do better. And we can see kind of going back in time how this model has tracked that. And right now it's firmly in the positive zone, so at a +4. So again, the monetary conditions, not just the Fed, the overall conditions are very favorable for risk assets, right? The conditions are very accommodating. But you can have too much of a good thing sometimes, and it can lead to problems down the road. And when we start talking about easy monetary conditions, a dovish Fed, we have to talk about inflation. And what we're looking at here, inflation is three different ways of looking at the actual inflation and one way of looking at where we think inflation's going. So that top chart, U.S. Consumer Price Index, that's in the orange color. That's the one headline you see get reported all the time. It's a year-over-year change. So some people get a little confused with this when they say, oh, inflation was 8, now it's 6, but my prices aren't going down. Well, that's because that's just measuring the growth rate. All that's saying is it was growing at 9, now it's growing at 6, but it's still growing. So in fact, since the COVID crisis, prices are up in total over 20%. So again, that's why rate is coming down, but prices are not coming down. They're still going up. So when we see that 2.44 at the end here, that says prices are risen 2.44% from a year ago. You're paying more. So the other way to look at prices and inflation is the core, and this is what the Fed really concentrates on. This removes food and energy. Their reasoning is that it removes the volatility. My reasoning is why remove it, since that's what we spend most of our money on as consumers, and it really matters what the price of energy is and what the price of food is. But you can see that that's a long way from the 2%, right? That's at 3.26%. And then finally in purple with the producer price index, that's the beginning of the production cycle. That's what companies paying for raw materials. And again, looking at it, the big takeaway, continued improvement, right? But not there yet. We're just not there at that goal. And if you look at the kind of rate of change, you can see it's slowing, and it makes sense. That last, mile is always the toughest one to really accomplish. So definitely nice to see the rate of growth slowing in prices, but really need to see that come down more before we can say success on the inflation front. And that last chart on the bottom, that's U.S. expected change in inflation rates. We watch this. This is like a gauge of what the consumer thinks prices are going to do in the next 5 years. So why does this matter? Well, it's pretty much a feedback loop. And the easiest way to explain this in simple terms is just think about you being one consumer, you going out and saying, I need a car, and I'm going to go buy a car. If I think that car is going to be more expensive a year from now, 2 years from 3 years from now, 5 years from now, I want to go out and buy that now, right? My pay is probably going to stay the same. My financial conditions aren't going to change. That price is just going to be higher. Let me go out and buy that now. But by you going out and buy that now, you're creating demand. What does demand do? Demand raises prices. So that price goes up and you get that feedback loop. Now, put that across millions and millions of goods and billions of consumers in the world, and you can see how that feeds into itself. And that expectation, when it kind of gets to that 3%, you get a little bit nervous. And that is one concern we really do have, is that the possibility of a resurgence of inflation. Again, the conditions aren't there yet. We haven't seen that signal yet, but it's something we're really, really watching for. And one reason we're watching for this is the labor market has been very, very healthy, right? What we're looking here is the unemployment rate in brown. So that's, how many people don't have a job. And right now it's currently at 4.1%. So given friction in people moving, the full employment rate is estimated to be right around 3.5%. So you can safely say we are very close to full employment. If you want a job, you can probably get one and you're getting a paycheck. And that paycheck's increasing. That's that blue line, right? How much money am I taking home? That's year-over-year wage growth. And you can see that that's at 4.1%. We saw earlier with inflation around that 2-3%, the simple math says my wages are increasing, prices are still increasing, but the wages are outgaining that. I'm taking home real more money. If I have more money in my pocket, I can spend more, which creates demand, which creates inflation. You can see where that feedback loop starts coming into play here, which is why we're really worried about that resurgence in inflation. But again, look at the total employment picture. It's really positive for future economic growth ahead and a positive signal. And it's really tough to see a way to a recession with these numbers. And we can see in the next chart, the consumer is feeling, and really more importantly, really acting on this economic. So now it's time to take a look at the consumer. I started off with the 30-year mortgage rate, again, up at 6.5%. And for those who have a short-term memory from a few years ago, saying, well, I got it at 3, I got 4, how can anybody pay 6.5? I think you just nailed it on the head on why the Fed's still cutting rates, even though we have not success on inflation and a strong job market. Is they're really trying to get this down, right? They're really trying to open up that housing market. I don't think they can get there, but they can try, and I think that's what they're really doing. But as a consumer and as a homeowner, you can see in that next chart, that green chart, which is the Case-Shiller Home Price Index, which just tracks year-over-year pricing. Prices are going up, right? Consumers should be feeling good as the prices keep rising. And we look at the data, like from Realtor.com. We look at the home ownership in America. A full 60% of homeowners have a current mortgage rate under 5%. And over 20% have no mortgage at all. So even though we can see that mortgage rate up top going up, and it may slow down the housing cycle a little bit, it may hurt people trying to buy the first time house. Those people who refinanced or have a home for a while are feeling pretty good about themselves with the home prices being so high and a lower mortgage rate than 6.5%. And you can see that in the next chart below, the US Index of Consumer Sentiment. And that's just measuring how consumers feel. Are they feeling good about the economy? Are they feeling good about their jobs? We try to measure this because you want to know when you feel good, you spend, right? When you don't feel that good, you don't spend. That affects the economy. So you can see that you can see the COVID dip, and you can see it kind of flatlining for a while. You can see that little rise at the end here. So consumers are feeling pretty decent with a score of 70.50. And even more important to us is that lower chart, the blue one. You can feel good, but are they actually spending? I mean, look at this blue chart here going out through history, X the bubbles from COVID here. You can see the big decline, the big bump up. It's right around 2%, and that's where we are. So consumers are feeling good. They have money to spend because they get real wage growth, and they're actually spending in the marketplace. So that's a positive sign. And again, a positive signal for the economy, which should lead to higher prices in the equity markets in the future. Another way to look at the economy is through the PMI surveys. I show these all the time. And red line is the services. That's that consumer. That's measuring the consumer. We know they're strong from the previous shot, and you can see that here. And anytime this is above 50, it shows an economy expanding. Anything below 50 is an economy contraction. And you can see that manufacturing is actually contracting, right, at 47. It's really flatlining down there. But you can see that strengthening consumer in this services PMI number up at like 55, and going higher, heading in the right direction. So again, trying to find that signal through the noise. Is the strength of the consumer enough to offset the weakness in manufacturing? Well, to us, the data says 100% yes, as they make up almost 70% of GDP. And you can see that right over here in the blue bar, that 67.8% is consumption. So that's a proxy for consumers. So how the consumers go has a big impact on what happens to GDP in the economy. And you can see we're looking at historical real GDP. So this is X inflation, right? So this is after inflation, the real growth of the economy, that we are above trend, right? Historical trend growth is about 2.1%. We're a little bit at 3. So again, we're really seeing the consumer sentiment and the wage growth translate to happier consumers, actually spending money, translating to real economic activity and growing GDP. So again, it's above trend growth, and it really just is not in the US, right? This is really a global phenomenon. You can see what looking at here is the PMIs again, looking at it for different countries. The top one's global, it's just manufacturing services combined. And then we have broken out by different countries. There's a whole bunch of data here, and you can get into like nitty gritty about what country's doing what. But I always use the heat map when I show these things because I think it really tells the story, right? And tries and gets to that signal. Green is good. Yellow, not so good, but all right. And red's bad. So when you see a lot of green there at the end, which we do almost entirely all green, you can see an economy in expansion, right? So there's trying to get that signal to the noise. You can always pick holes in one country and why it's not growing the right way. But overall, you can see a lot to like in the economic activity in the global economy. So we have an expanding global economy, not just a US economy. So the last piece I'll show on the economy before we get into the equity land is this recession watch chart from my friends at Ned Davis. We've been partners with them, for many years now. They have great data, and this is something they put together, trying to predict when that increased chance of a recession is about to happen. So what they do is they put together a bunch of data points, right? They look through history. What have been characteristics of the economy when a recession has hit? What has been characteristics of the equity market when a recession has arisen? They put that all together, and they come up with this orange line. And you can see that throughout history, you're really looking for that 70% chance, right? Once it gets to 70%, there could be a recession probably. You don't have to wait to get to 70 to adjust portfolio, but that's when you get really nervous. We see what we are right now, that yes, it's definitely rising. You can see that, economy may be slowing, not contracting, but slowing a little bit, but it's only at 40, right? So you have a long way to go before those recession probabilities really need to creep into asset allocation. So there's a low probability of recession out there, given the historical model from Ned Davis here. So again, putting the economy all together, trying to find that signal, right? The signal to the noise. It's a healthy, growing global economy. Very low probability of a recession. You can see here from the Ned Davis. The weight of the evidence in the macro land is supportive of risk assets, right? And it's really providing support for future prices, future price appreciation. So again, a very strong economy at the overall aggregate level across the globe. So that's the macroeconomic data. Now we're going to turn to equity land. And as always, for those who have been on this presentation with me since the beginning, and have talked to me on the phone and in person, we really always start with valuation. And why? Why do we always start with valuation? Well, it's the largest, not the only, but the largest influence on financial asset returns. What you pay for an asset matters. And I brought up this chart from my friends at Ned Davis, and it really expresses that very clearly. So what are we looking at here? Well, we're looking at anything in blue is the S&P 500 index. Anything in orange are bonds. We're looking at 10-year forward return. So, like every month, you just do 10 years forward, 10 years forward, going back in time to 1976. So a lot of data, right? And a lot of periods. And you can see that moving 10 years forward, the best time to buy any asset, doesn't matter if it's equity or fixed income, are when they're cheap. The worst time is when they're expensive. You still earn some positive returns over 10 years when you buy it expensive, but you earn a lot more and you increase the chances of a positive outcome by buying cheap compared to expensive, right? So, and we know valuation is not a good timing tool, but this data shows paying attention to valuation metrics, you can increase your chances of success, right? And really in investing and in ultimately meeting your clients' financial goals. So that's why we really focus on that. So looking at the valuation picture from the S&P 500 lens doesn't look pretty, right? At the headline, we're about 21 and a half times forward PE. Average is 16, and PE is just price over earnings. So what are you paying for a dollar earnings? Using a different version of the PE CAPE, looking back 10 years, adjusting for inflation, you see it's at 35. Again, 30-year average is 27, so expensive. Very low yields, 1.35, averaging about 2. Price to assets, like what they have on the balance sheet, very expensive on the price to book. Price to cash flow, and how much you're paying for $1 in cash flow, 2 standard deviations overvalued, right? So no way around it. Headline index that has a heavy dose of that Mag 7, almost over 30%, is very expensive on any metric we look at. But if you are willing to move away from this index a little bit, there are pockets of opportunities that can be taken advantage of. And what we're looking at here is what we call factors. And for you who have spoken to me at meetings, on these presentations, we look at the equity market through a factor lens. What is a factor? It's a characteristic. That's all it is. When we look out through time, look at historical equity returns, what characteristics have produced the best returns? And going through time, small size has a big impact, a higher yield has a big impact. We know that valuation has a big impact. So you kind of break the US equity market into those buckets. And then when you put this together on the spreadsheet, you see what is cheap and what's expensive. Because we saw from that previous slide that when you buy something cheaper, you have a probability of a better outcome. So just looking quickly at this sheet, you can see where the cheaper factors are compared to more expensive. Size, definitely small, definitely cheaper. Dividend yield, higher income stocks. What's expensive? Those margins, growth, those are those high quality Mag 7 names. Now, when looking at this, we get asked this a lot, then why don't we just all go into size and dividend yield? Again, it's not a timing tool. It's not a this or that. It's not all in. It's where do we want to tilt the portfolios to find the best risk return opportunities in the marketplace? We want to tilt into that valuation support. So that's why we have an overweight to some US small cap stocks. We just added to dividend yield in the quarter. Valuation, we have an overweight too. So it's all about where to tilt your portfolio and all about increasing the probability of meeting your financial goals. Now, that's just a US equity market. But if you want to move even farther afield, a whole new world of valuation opportunity becomes available to you. And this is kind of looking at the equity market, but now looking at it through an international lens. We still have the S&P 500 up there, very expensive. Russell 1000 growth, still very expensive. India, very expensive. And these first ones are relative to itself. So how expensive is it itself compared to history? And this is to the ACWI, right? The global benchmark. Is it cheap or expensive relative to what we can buy in the marketplace today? Again, love the colors. Kind of gives you a quick look at, what's working, what's not working from a valuation standpoint. So when you look at this, you can see that the valuation support is over in international. And again, like we talked about in factors, doesn't mean you sell all your US exposure and go into international, but on the margins, you want to tilt into that valuation support because we know over the longer term, it should provide a better return stream. And that's how we position client portfolios to take advantage of those valuation dispersions in the marketplace. So although valuation is a major piece of the puzzle, it's not the only one. Technical indicators also play a major role in future market returns. So now we're going to take a look at the market through a technical lens and give us another clue on the potential for future price appreciation and help us find the signal through the noise. So looking at the S&P 500 index, again, the same one we use for valuation, same one we use for the factors. And you can see it's a strong uptrend, right? Going back 5 years, it's in a pretty strong uptrend, no doubt about that. You got comfortably above its moving averages, right? It's moving average 50-week, 200-week. These two lines. You want to see those upward sloping to the right. That means it's not volatile. It's not going up and down. It's heading straight to the right. We look at the RSI up top. That is it overbought? Are too many people rushing into this? Above 70 makes you nervous. So, we have some room there. So it's not above 70. And the lower one is just short-term and long-term momentum. Short-term momentum increasing compared to long-term, which is usually positive. So when we kind of look at this from a technical standpoint, strong uptrend, comfortably above its moving averages and support signals. So that cyclical bull that we saw that began in October 2022, and we saw that on the previous chart, we can see that right here when it kind of hit its 200-week moving average, is alive and well and should portend to future price appreciation in the future. So that's the overall technical picture. But another way to look at technical picture, another piece of the puzzle to add is looking at the breadth, right? And we saw that in the second chart. We looked at that at least for the S&P 500 equal weight, that there was a lot decent breadth in the marketplace. Now we're taking a look at the global equities. And why do we look at breadth? Bull markets tend to be strongest when broad and weakest when narrow. The more support you have, the more powerful the move and the longer it can be. So we're looking here. This is the ACWI. So again, when you see here ACWI, think S&P 500, just adding international stocks. That's all it is. It's still just equity stocks. They just happen to be global, not just the US. It still includes the S&P 500 names, but just adds in the international names. And again, we're looking at moving averages, 50-day and 200-day. And all this is saying is how many stocks are in uptrends, right? How many are in a bull market? How many are doing well? And when you get that above 50, you can say the majority of stocks are in an uptrend, and that is good. And you can see from a 50-day moving average, almost 60, and the same thing for a 200-day moving average. So the more stocks that are participating, the stronger the signal. And looking globally, breadth is providing a very strong positive signal for the marketplace and future price appreciation. Not all is rosy technical land. It really ever is. You never really get that 100% fat pitch. And the kind of fly in the ointment for technicals is sentiment, right? That's the last factor we're going to look at. Can be a big driver, especially of short-term returns. You can see like today's market is really driven by sentiment more than anything else. No fundamentals have changed, it's just sentiment. You can see from above that we're really experiencing extreme optimism. And again, our friends from Ned Davis going back in time. This time we're looking at the S&P 500, so we're focusing on the US here. And this just kind of measures our investors' extremely optimism, extremely pessimism. They use positioning, asset allocation of the different clients, how institutions are allocated. A lot of letters out there from the stock market, are they bullish or bearish? And they come up with an indicator. And when you get to the extreme optimism zone, it's a contraindicator, right? And that means that when it gets too good, it usually is. So think about it, right? If everybody's on board, with the stock market, who's left to buy? If everybody's bought, who's left to buy? So when it gets too extreme, you usually end up a reversal. So taking a step back, looking at the signal from a technical standpoint, despite the sentiment concerns we see here, the weight of the evidence and the technical setup still leans positive for price appreciation in the equity markets. So a good technical setup in the markets. Coming to an end, earnings season is almost 2/3 of the companies have reported, so we're kind of getting near the tail ends here. I'm seeing some signs of weakness, but the overall picture still remains positive. Over half the companies reported have beat expectations, which is pretty much in line. You kind of think about it from the big names like Amazon, Google, not so well, and we saw the prices get punished. I mean, Amazon, Google, very good. Sorry about that. Amazon, I was wishful thinking. Amazon and Google had good earnings. You saw them kind of go up. And Apple and Microsoft, not so much. A little bit poor guidance. You saw them go down. So again, that 50-50 split. But more important to us is this EPS revision number. And this gets factored in as these companies report. And basically what we're trying to capture here is more analysts upgrading than downgrading stocks. Are earnings expectations increasing or decreasing? And it makes sense, right? And that's one thing we really look at when we look at these signals and the data we look at. Not only does it have to work through history, it also has to make some type of economic sense, right? You just can't throw a factor out there and correlation is not causation. So it really has to make some economic sense. And it makes sense. When analysts are getting more bullish on companies and earnings are going up, then that's good for the stock market. Like we said, overall, anything above 1, there's more upgrades than downgrades. So US, very strong upgrades. Japan, very strong upgrades. Even the US small cap, almost at 1. So again, not every place in the entire globe is having positive revisions, but enough is to offset the ones that aren't. So again, looking at earnings, a little bit weaker than expected, but still a positive influence on prices. So we'll have to see how this turns out in Q4 to see if this continues. But for now, earnings are a good sign for the equity market. So that's kind of where we stand with the equity market. Now I want to turn to fixed income. And in fixed income, we're going to start with the yield curve. This is a U.S. Treasury yield curve. So what is this? Well, the first thing is you see 4 squiggly lines up here. And what that is just different time periods, right? So you can see them up here, 12/31. That's the beginning of the year. That's this black line covered by a few lines here and there. Then you have June, right? And that's this aqua line. You have the end of August, which is this salmon or pink line. And the blue line is where we are at the end of September, right? And all this is measuring is that how much interest can you earn at that point in time in a treasury bond by lending them money at different time periods, right? And you would expect that it's usually upward sloping, right? To lend 20 years is a lot more risk than lending 3 months. You'd expect more interest for that. Now, it's not been always the case. And recently we've had this inverted yield curve, which is saying something is wrong. But that's what we're looking at here. So what does this tell us? So with the Fed delivering a 50 basis point rate cut and setting expectations for another 25 tomorrow, no surprise, we've seen a large shift down, right, in the yield curve. So again, we look at just this 3-year. On June 30th, to lend the government money, I was getting almost 5%. To lend the government money now for 3 years, I'm only getting 3.5%. And that came across the curve. This is what the Fed's trying to do, right, by lowering borrowing costs. This is their main transmission mechanism with the Fed funds rate, because they don't directly control these rates. And no one borrows at the Fed. They're just trying to use the Fed funds rate to control some of these rates. But you can clearly see the influence by this huge step down once the Fed started lowering rates. When we look at the longer end, 20 and 30 year out here, they moved the least. You can see that down here, that they were the least impacted by the rate decline. Again, to us, this is good, right? It's pointing to market expectations of future economic growth, right? A higher terminal Fed funds rate. This is a good sign that the economic growth, the Fed, that there's growth out there and that rates are going to have to rise at some time. Now, all rate rises are not bad. If you have strong economic growth and you raise rates into that, that's a good thing. And what this curve is telling you by that long end not moving much as the short term is that yes, the Fed's definitely coming down. In the short term, they're going to be a little bit lower in rates. But for that longer end, either due to a resurgence in inflation, which would be bad, but again, that could be a reason why the rates aren't moving as much in the long end, or we get strong economic growth, the Fed's not going to have to lower rates as much. So as of right now, this is a good sign for the marketplace that we're seeing good, strong economic growth, at least expected from the bond market. So another way to look at it, those spreads, is looking at it from corporate world, right? And that's what we're looking at here. We're looking at that same information, just kind of all aggregated together. The black line is a corporate high yield index. Those are companies that may be a little bit struggling, smaller cap, have trouble borrowing, not the Apples of the world. Then you have this US corporate index, which is the Apples, Microsofts of the world. That's the green one. As expected, they can borrow for a lot less. What this is measuring is just how much they have to pay over that previous rate we saw, over this, it's Treasury, which is a risk-free rate, to borrow. What's the takeaway? No stress and spreads. And when we talk about stress, we're talking about these high rates. And again, it makes economic sense. If you're uncertain about the future, if you expect a recession, and these are banks lending to these companies, so they have a better insight, hopefully, than I do into this, and to you that you do, is they're lending to these companies at pretty decent rates. They're not scared about being paid back. They don't see that recession coming in the future. So again, and given that they're almost at record lows, we look at compared to history, the spreads, you can see that no stress, no canary in the coal mine in this. Now, given the strength we're seeing and how the spreads are, there's not a lot of room for improvement, right? You can't really get much lower than what we are right now because no one's going to lend to corporations at treasury rates. But we don't need to see improvement in this, right? We just need to stay away from those rises we saw like right before the financial crisis and during COVID. We need to stay away from those spikes. Those are ones where we need to stay away from to be positive impact. So even with this lack of spread and the rates that came down from the recent higher income can still play a vital role in the portfolio, right? Not only for diversification purposes, that's a great reason to hold some fixed income. It does work as a great diversifier, kind of anchor in the portfolio when, all things go to hell. But we have a higher terminal rate environment. We can get more income than we have been used to in the past, which can provide an attractive risk-return trade-off, which I'm trying to display here in this chart. So what we're looking at here from our friends from JP Morgan is just, the yield as of 9:30. We saw that in the other chart. And the corporates, right? And high yields, different parts of the fixed income market. The first thing for people who have been following this for a few years, these are very high numbers compared to where you could get 3 years ago, right? Investment grade corporates, you may be able to get 2%. 5-year treasury, you could probably get 50 basis points if you're lucky, maybe 25 lending. So those rates did come up a lot. With those rates coming up a lot, it affects the impact of the Fed on bond prices. And that's what we're capturing over here. And that's what I want to focus on. So what this is measuring duration. And short, sweet, simple duration is just how much a bond's going to move, holding everything equal if rates were to rise 1% or fall 1%. And you can see that here. If the rates fall 1%, it's this dark blue. If they rise, it's this brown. And you can see all the numbers here. When we showed you this 3 or 4 years ago, you were heavily skewed, and all that means is you had more outcomes on the left-hand side, which are negative, than on the right-hand side, which is positive. And we can see that it has totally switched, right? So it doesn't mean that all outcomes are going to be positive. Yes, you can still lose money in bonds, but the risk-return profile has switched, right? You actually are kind of skewed to the positive side. So you get positive skew, which is kind of what you want when you're investing. You have more outcomes to the good than the bad. So again, fixed income, given this higher income coupon that they have now, can play a vital role in client portfolios. So let's put this all together and really find the signal through the noise. And we're going to start with the risk model from our friends at Ned Davis. And I'm sure most of you hopefully have been familiar with this model that we show it a lot. Again, friends at Ned Davis. I'm only showing a couple years here, going back to 2015. They have data going back to 1981. It just doesn't really fit too well on the screen. And again, what they're trying to look at is those factors that drive returns, right? That historically have proven that markets are going up or down. And they break it up into 4 different indicators, which is consistent of 30 or more sub-indicators in that model. aggregate that all together to come up with, is it bullish or bearish for risk assets? And when we talk about risk assets, we're mostly talking about US equities or international equities as well. So you can see from the last time we met, he's down by 1, right? And it really was that sentiment. We saw that chart earlier where sentiment was really creeping up too high for comfort. That puts his score currently at a +1, which is bullish, right? His last buy rating was from December 2023, so he's been bullish since then. He'd have to drop to a -1.5 to get bearish. So again, he's firmly in the bullish camp, really providing support for future price appreciation ahead. And you can see that monetary and combo, which is just combo means just models of other models. So again, a lot of data goes into this, 30 or so sub indicators, all to come up with an idea of how much risk is out there and is it safe to take risk, or if it's safe, more attractive, I should say, to take risk. And from the NDR Fab 5, it's definitely attractive to take on risk. We love the model at NDR. We use it extensively. We also know that it does have some limitations in our mind. From early in the presentation, we have a higher weight to value. So we want to capture that. So we built a model that kind of enhances what the Ned Davis model is. So we built this internally. So we don't have this going back to 1981, but we do have the data if anybody wants to see it. Again, still trying to do the same thing. How much risk is in the market? Is it attractive to lean into risk in the market? So what's our model telling us? It's capturing a similar signal. It fell in the quarter from +1 to a -1. And that's right here. You can see -1. We view this as noise, not a change in signal, right? As you can expect, volatility in this data from month to month, quarter to quarter, it might go up 1, +1, -2, +2. But until we see a firm trend or it breaks through a level and stays there, it looks more noise than anything. And what we really saw that moved it was the valuation, right? And we know that's not a good timing. So again, valuation picture definitely got worse. It hit our model, but it's not signaling a change to the overall positiveness of taking on equity risk in the markets. We're definitely watching this closely. But for now, the two models, right, they're in alignment. And the positive risk environment is reflected in model asset allocations for our clients, which we're going to take a look at the next chart. So no change in signal, no large-scale changes in the quarter. Overall asset allocation is the same that we had last quarter. Overweight to equities, no surprise, right? We saw the strong economic data, strong technical picture, strong signal from the risk models that we use. So we want to be overweight that risk assets. We're taking that excess risk in the US. Again, taking some small caps, some dividends, some value, allocating to those. Internationally developed, we saw the nice strong valuation picture there, so we want to tilt into that. Emerging markets, we're all right with, but we want to maintain a neutrality in there. A lot to do with China. Really don't think that's too investable right now, so we don't want to go too overboard. Just maintain our neutrality. But overall, liking risk assets. Fixed income, still underweight. We talked about the higher income. We talked about the more positive skew in returns. All good stuff. Not good enough to really push us to overweight, especially given seeing the opportunities in the US equity market or the risk assets and international that we're seeing. So we're still underweight, but do have a very healthy exposure to fixed income. Opportunistics, this is where we can kind of judge that risk, given where the modeling and where we want to be, and definitely overweight risk assets in an opportunistic bucket of our portfolio. Again, cash, the Fed's going lower. It could be another 25 in stop, another 50 in stop. Any way you look at it, given the technical backdrop, the fundamental backdrop, the macro backdrop, you're probably going to end up with a better return in risk assets based on the modeling than in cash. Doesn't mean cash you can't own, and doesn't mean your individual circumstances may say that given the safety I need, I'm buying a house, I'm buying a car, I need to be safe with these assets. Cash is still attractive at around 4%, but giving a diversified portfolio, you don't want to be overweight cash given this environment and what we're seeing in this. So there's no overall change to asset allocation, but there were some changes under the hood that I've alluded to a little bit here and there. So we moved some of our exposure away from the S&P 500 index, represented by a quality factor ETF, right? Those tend to be more exposed to the top names in the index. So those MAG 7, the ones that are overvalued. So we trimmed some of that and used those proceeds to buy the more attractively priced dividend-paying stocks that have a higher yield, that are trading a little bit less expensive than we're seeing from the index. So you're really taking advantage of that valuation dispersion, tilting into the valuation. And then for our more conservative clients, we also added slightly to duration from short-term bonds. I just kind of spoke about giving the Fed higher starting yield, Fed expectation for lower rates. The lower rate tends to react more to the Fed. Given that we're closer to a normalization of Fed funds rate, it's all right to take on a little bit more duration. Again, from an asset allocation point of view, we don't want to go overweight, but taking a little bit more risk of closing a little bit of that underweight gap is not a bad thing for conservative clients, which we did in the quarter as well. So kind of putting it all together and thinking about what we learned today and what some key takeaways we have from this presentation. Accommodating Fed, but the impact starts to wane as the rates normalize. The market agrees with the Fed. We get more to a closer normalization. They're going to have less and less impact on the markets. That means monetary and economic conditions come more to the forefront. And we're seeing that, right? That it's really positive on the monetary and economic side. Seeing continued strong economic growth. When we see strong economic growth, no recession, we tend to get stronger equity returns. And that's what we're seeing in the marketplace right now. From a technical standpoint, uptrend is strong, good breadth. Sentiment's creeping up there a little bit, but the overall picture is still positive and supportive for future price appreciation. We looked at the fixed income market, right? No stress. Those spreads are still pretty tight. Not seeing a lot of stress in the fixed income market. Higher starting yields than we've seen from years ago, maybe not from the beginning of the year, from where we're seeing 2, 3, 4, 5 years ago, make it a little bit more attractive to be in fixed income, given that higher coupon you get. The multi-factor risk models we saw remain bullish. Weight of the evidence is really pointing to an attractive environment for taking on risk. So what we want to do in that environment, remain balanced, tucking into those tactical opportunities, taking advantage of valuation dispersion like we saw in the dividend play, selling some of the more high expensive stocks and buying some of the more cheaper stocks to get that valuation dispersion in the portfolio. So with that, that's the Appendix A, is our compliance disclosures, and we have this on the website if anybody wants to read it. And with that, I will turn it back to Amanda to see if we have any questions.
Hi, Chris. Thank you so much for all of that information. So we do have a couple questions, but just as a reminder to use the Q&A button on the bottom of your Zoom window here if you want to submit any questions about what we just heard. But we'll get started here with the first question is, does the weak performance in equity markets in September give you any cause for concern?
Less after this morning, the big rise in. But yes, we're looking at September's price in the market. It did give us pause for concern. Again, anytime a market goes down, we're not happy with it. No one should be happy with negative returns, but they're normal everyday occurrence that happens in the marketplace, normal volatility. And again, that's that signal through the noise. Is a small dip in the marketplace telling you something new, something has changed, something you need to adjust, or is it just normal everyday volatility? And with that, you want to use our indicators to understand. So when we look at the technical picture, it'll show that little dip here in October. I think the dip was actually in October, not September. So in October, that it didn't impact any longer term trends, right? It didn't break any moving averages, didn't break any support. So while never happy with negative returns in a short time period, it didn't break any longer term trends. So the bull market is still intact. So again, cause for concern anytime you see negative performance, but it really depends on the impact of the overall longer term trend and trying to find that signal through the noise.
Thanks, Chris. The next question I have is, what are your thoughts on investing in gold? And do you hold it in our client portfolios here at Stonehearth?
Yes, gold. I do like gold. I do like gold as a hedge for Armageddon, for global chaos, for the debt. We didn't even talk about the debt this time. I just didn't want to depress anybody anymore. So I kind of stayed away from the government debt. Gold is a good hedge, a good placeholder for that. And we saw it getting decent performance, right? It's up almost 50% over the past year. So you get very strong performance from it. So it acts really well as a store of value and a nice hedge against all that could go wrong in the marketplace. And again, that doesn't mean you put all your assets into gold because, again, you see the positive for taking on a risk environment. We want some of that risk. And if you're leaning into risk that much, it's kind of always good to have that balance and maybe offset it with something that may zig when it zags and help provide support for client portfolios and let them achieve their financial goals. So you probably know the answer to the question. Having said that, yes, we do own gold in our asset allocation. Again, as of right now, we don't see any reason to sell. It's a little bit weak today, but again, very short term. So yes, I do think gold can play a decent role as that kind of safety play against Armageddon. And as we've seen in the past year, provides a nice upside.
Thanks, Chris. It looks like just in the uh, essence of time here, we'll just end with this last question. Do you recommend investing in the Bitcoin ETF?
Bitcoin. Seems like endless questions on Bitcoin. Again, especially after today, I think it was up 7% this morning, something like that on the Trump victory. Um, yeah, so Bitcoin's been around for a while. I think the new invention this year is what this person pointed out was the mutual fund ETF where you get exposure. So before you had to go to Coinbase, open up an account, put a thumb drive in your computer, password protected, pull it off, and you walk around with it, and that's your Bitcoin. The SEC, in its infinite wisdom, decided that we can now put that in a wrapper, and that wrapper is going to be an ETF, and people can get exposure to that. So we have looked at Bitcoin before. We didn't invest in it. We looked at it constantly, as we do all assets that can be included in clients' portfolios. But we did take a harder look at it when it kind of came out in this ETF format because it's a little bit easier for clients and portfolios to get exposure for it. And when the investment committee and myself kind of looked at it, the conclusion was that adding Bitcoin exposure to our current allocation really doesn't increase the probability of meeting our clients' financial goals. And that's what we're always trying to do. And that conclusion really rested on really two pillars, right? Bitcoin has not been a store of value. It's been sold as a store of value, but it's been highly volatile. I think in 2024, it's experienced five drawdowns of 10% or more. Over the past 5 years, two drawdowns of over 50%. So it trades more like a meme stock, right? Than an actual store of value or give you something different in the portfolio. And that's the other last point was, does it give you something different, right? If I already hold equities, I hold some risk assets, adding Bitcoin, does it improve my portfolio outcomes? Does it improve the upside? Does it give me some kind of downside protection? And contrary to what a lot of pundits put out there, the current incarnation of Bitcoin is trading like other risk assets. I think, last week I was looking at it, the S&P is up 12, Nasdaq's up 13, Bitcoin ETFs are up 12. It had a nice run when it first launched. It's having a nice little small run today. But in essence, you're getting just another proxy for risk. And you can see the downside volatility in the drawdowns. So, the path is just a lot more bumpy to reach the same spot. There's really no diversification benefit, and you don't increase the upside. Trades the same direction as other risk assets, increases your chances of having a graded drawdown. Really seeing a good recipe for investing success in the Bitcoin, given that we already have exposure to risk asset proxies through the equity market. But we will continue to monitor. So if anything changes and it can add value to a portfolio, we definitely would not hesitate to add it. We just don't see it yet.
Chris, I just want to thank you so much for all of this information today and for all of you who were able to attend this webinar and join us. We are ending out the year here, and we'll be discussing Q4 in January of next year. You can find all the registration information for that next Zoom on our website, which is www.stonehearthcapital.com. And right now we have that scheduled for January 22nd of 2025 at 12 p.m. So you can go ahead and register for that if you'd like. And we just want to wish everyone happy holiday season as we finish out the year. And we look forward to chatting with everybody in the new year. Thanks, Chris.
Thank you, everyone. Have a happy holiday season. See you in the new year.